Hi traders, welcome. It's time for a little update on my tracked accounts. Let's start with the automated uh, strategies and then let's look at the manual ones. So this is the automated strategies. As you can see, these continue to perform very well. So the profit ratio is around 58.16%, so went down a little bit. But you see the comparison of the maximal drawdown to the net profit is very good. It's still around 2. These are very low risk parameters, as you can see, so below 0.3% risk per trade, which is very, very low. But that's easy to increase the risk per trade. All the numbers will just be higher in absolute terms. But as you can see, a nice increase, consolidation in the new high in the equity curve. So that's powerful for the automated strategies. On the manual side, the performance is slightly higher. You can see that the win-loss ratio is higher, 65.96%. That's what you would expect, of course. Yeah, overall, also the risk per trade is quite low. So it's easy to see that the manual approach slightly outperformed the auto approach. Unfortunately, I had to cash in the 50k real money account, which I was tracking also in this series. But to make a long story short, what can you conclude from this? Yeah, I mean, that both is possible. Automated trading is possible. It takes many years of preparation, like I've said many times. Each strategy can easily take 2, 3, 4 years in development time. That's what people don't want to admit. And that's the whole phase of back testing with tick data, forward testing, and then live testing. Okay, these are the 3 phases. But as you can see, it's worth it. I mean, I will probably always trade, in my life. Even if it's just for myself, because this is still better than having all the risk which comes with stock portfolios. Regarding the manual approach, of course, it requires time. So you need to invest the time to trade manually. And this is a big factor, especially if you are an entrepreneur. But of course, manually you have the potential to outperform the bots, especially if you use the market causality, depending on your risk appetite. If you stick to the known setups, you can see it's very profitable. I think also I will, because I did that in the past a lot. This shows you over the time period where I have tracked and publicly shown these equity curves that both approaches are valid. Either way, what works in Forex is the market causality. You can't get those kind of curves with statistical approaches. No matter what somebody tells you. All the trades here have a balanced stop, not an equity stop, a balanced stop. You see? So it's not an emergency stop which is super far away. It's literally a balanced stop compared to the take profit. There's no hedging or pyramiding or martingale or high frequency and all these things which will blow up. There's no built-in blow-up risk. It's very solid. And the same goes for the manual trading. Each trade is protected with a stop. The risk per trade is controlled and managed. Over time, you can outperform basically all the common asset classes with that. Alright, that's when you reach professional status as a trader, I would say. Of course, there are many venues which can be taken. You can try to collect investment capital from investors and trade a fund. That's a whole topic on its own. That's a whole another layer of things you gotta manage on top. But in terms of the trading, it's very nice to see these things. All the best.